Unit 5, Capital Gains Tax Part 2, Lecture 1, Calculating Base Cost. Calculating base cost. In some instances, the base cost of a capital asset first has to be determined in order to calculate the capital gain or loss. There are three methods that can be used to do this, which we will be looking at in this lecture. If an asset has been owned prior to 1 October 2001, the date when CGT was introduced, the base cost of the asset has to be calculated first. This can be done by either determining the market value on the 1st of October 2001, using the time apportionment method, or using a value equal to 20% of the proceeds from the sale of the asset. The method that yields the smallest capital gain will then be used. Method 1 is where the market value of the asset on 1 October 2001 is determined by a qualified valuator. Method 2 is 20% of proceeds. This method is mostly used when there are no records of purchase price or if it yields a higher base cost value than the market value method. The time apportionment method is calculated by means of using a formula. This is done to apportion the profit made for the assets partly owned before 1 October 2001. For example, if an asset was owned for a duration of 15 years and 4 years of that was before 2001, only a portion of the profit has to be subject to CGT. There are, however, two variations of this method. A formula for assets owned and all expenditure incurred before 2001, as well as for cases where expenditure occurred after 2001. If all expenditure occurred before 2001, your standard formula is used. If a portion of the expenditure was incurred after 2001, you will need to adjust the proceeds factor of your formula accordingly. Take note that part of the year is treated as a full year and that your N variable gets limited to 20 if expenditure occurred in more than 1 year. In the example, B is all expenditure before 2001, P is your proceeds, N is the number of years from acquisition until 1 October 2001, and T is the number of years from 1 October 2001 until disposal of the asset. In this case, the base cost is 300 Rand and the capital gain therefore is 400 Rand. If we consider the same example, but now we have post-valuation date expenditure incurred of 200 Rand, it will change your calculation as follows. Firstly, you need to adjust your proceeds variable with a second formula. Once completed, you'll use that adjusted value as your new P variable. Now we have a base cost of 144 Rand and a capital gain of 356 Rand. Here we have another example. If a person acquired an asset in 1997 and disposed of the asset in 2003, what are the CGT implications? Again, we are not given a base cost, so this has to be calculated first. And for purpose of explanation, we are only using the time apportionment method. And another example of pre- and post-valuation date expenditure. Remember, when we have post-valuation date expenditure, we need to adjust our proceeds variable first, then calculate the base cost. Also, if you had pre- and post-expenditure, your N will be limited to 20, as is the case in this example.